In September 2008, the United States came within 72 hours of a complete collapse of its financial system. Not a recession, not a correction, a collapse, where ATMs stop working, where companies cannot make payroll, where the entire architecture of modern money stops functioning. Most people who lived through it know the headline. Banks made bad bets on mortgages and got bailed out. That explanation is accurate the way saying a plane crashed because it hit the ground is accurate. The actual cause was built into the system 15 years before anyone called it a crisis. The people who built it understood exactly what they were building. The documents prove it. The Financial Crisis Inquiry Commission, a government body formed specifically to investigate what happened, produced a 662-page report in 2011. It contains internal emails from ratings analysts, written in 2006, 2 years before the collapse, describing the instruments they were rating, AAA, using language that never appeared in any public statement. Those emails are in section 2 of this video. By the end of this video, you will understand the exact structural moment when the 2008 collapse became not possible, but inevitable. It is a specific, identifiable moment. It happened in 2004. Almost nobody talks about it. Once you see it, every financial crisis you read about for the rest of your life will have a shape you can recognize. To understand how the 2008 crisis was built, you have to begin a decade before anyone used the word crisis. You have to begin with a mechanism that was functioning, legal, and producing enormous profit, and understand why all three of those things made collapse more likely, not less. For most of the 20th century, the mortgage system worked like this. A borrower approached a bank for a home loan. The bank assessed the borrower's ability to repay. The bank issued the loan. The bank held the loan on its own books and collected monthly payments for 30 years. This structure created one critical incentive. The bank had every reason to assess the borrower carefully. If the borrower defaulted, the bank absorbed the loss directly. Risk and responsibility sat in the same institution. That alignment is the key feature. Hold it in mind. It disappears in 1994. By 1994, a different model was expanding rapidly. It is called securitization, and the concept had existed since the 1970s, but its scale in the 1990s was new. Under this model, a bank issues a mortgage and then immediately sells it to a Wall Street firm. The Wall Street firm packages hundreds of mortgages together into a single security, a bond backed by the combined mortgage payments. This security is then sold to investors, pension funds, insurance companies, foreign banks. The originating bank collects a fee for issuing the loan. It collects nothing for the loan's performance over 30 years because it no longer holds the loan. This is the incentive inversion. The bank that decides whether a borrower can repay has no financial stake in whether the borrower actually repays. That single structural fact is the origin of everything that follows. By 1994, $100 billion in mortgage-backed securities were being issued annually. This was not a fringe experiment. It was already a central feature of the American mortgage market. The investors buying these securities needed a way to assess their risk. They were too far from the original borrowers to evaluate the loans themselves. They relied on a third party to do it for them. That third party was the credit rating agencies. The three major rating agencies, Moody's, Standard & Poor's, and Fitch, operated under a specific business model. They were paid by the Wall Street banks whose securities they were rating. This is not a conspiracy. It was the disclosed, legal, standard operating procedure of the industry. The conflict of interest was structural, not hidden. The rating agencies competed for business. A bank that did not like the rating it received could take its security to a different agency. This created pressure, not from corruption, but from competition, to issue favorable ratings. The market called it ratings shopping. The agencies called it business. A AAA rating meant the security was considered as safe as a U.S. government bond. The investors buying these securities trusted that rating completely.
That trust was the load-bearing wall of the entire system.
Between 2000 and 2003, the dot-com bubble collapsed. The Federal Reserve, attempting to prevent a prolonged recession, cut interest rates aggressively. By June 2003, the federal funds rate reached 1%, the lowest it had been in 45 years. Low interest rates mean low returns on safe investments. A pension fund, an insurance company, a foreign central bank, all of them were suddenly earning almost nothing on government bonds. They needed yield. They needed something that paid more than 1% and was still rated safe. Mortgage-backed securities rated AAA paid significantly more than government bonds and carried the same rating. The demand for them was not irrational. Given the information available to investors, it was entirely logical. The problem was that the information available to investors was wrong. This is what investor demand looked like in practice. Mortgage-backed security issuance grew from $493 billion in 1996 to $3,814 billion in 2003, nearly an eight-fold increase in 7 years. That demand required a supply of mortgages to fill the securities. More securities meant more mortgages. More mortgages meant more borrowers. More borrowers meant lower standards for who qualified as a borrower. The machine was now creating its own fuel. The structure had become self-reinforcing. Investor demand created pressure for more securities. More securities required more mortgages. More mortgages required more borrowers. More borrowers required lower standards. Lower standards produced higher-risk loans that were packaged into the same securities and rated with the same AAA label. The feedback loop had no internal correction mechanism. There was no point in the chain where anyone had both the information to see the problem and the incentive to stop it. This is the structure that was in place by 2003. Section 2 shows what Wall Street built on top of it. The timeline of the setup spans exactly 1 decade, 1993 to 2003. During that decade, 3 independent developments converged: the expansion of securitization, the collapse of the dot-com bubble driving investors toward alternative yield, and the Federal Reserve's rate cuts making safe assets unacceptably unprofitable. None of these developments was, in isolation, a crisis. Together, they created a demand for mortgage-backed securities that could not be satisfied by creditworthy borrowers alone. By 2003, the industry had run out of good borrowers. What it did next is Section 2. This is the Financial Crisis Inquiry Commission's own finding, not a critic's assessment. The government body formed to investigate the collapse, examining the same documents you would examine if you spent 3 years reading everything. Responsibility and accountability were structurally removed from the system before the crisis began. That is not hindsight. The incentive structure made it visible in real time to anyone who looked at it. Some did look at it. They are in Section 2 as well. By 2003, 68% of all subprime loans made to the least creditworthy borrowers, were immediately securitized and sold. In 1995, that figure was 31%. This means the banks originating the riskiest loans were retaining almost none of the risk from those loans. They issued the loan, collected the origination fee, sold the loan, and moved on to the next one. The borrower's ability to repay was, in measurable structural terms, irrelevant to the institution making the loan. The setup took a decade. The machine that was built on top of it took 3 years to reach full capacity, and required instruments so complex that the people selling them to investors frequently could not explain how they worked. Section 2. Between 2003 and 2006, Wall Street built a financial machine of extraordinary complexity on top of the existing mortgage securitization infrastructure. The machine had 3 primary components: the CDO, the synthetic CDO, and the credit default swap. Understanding each one is not optional for understanding 2008. The collapse cannot be explained without them. A CDO, collateralized debt obligation, is a structure that takes multiple bonds, pools them together,
and issues new securities from the pool in layers called tranches. The key feature of the tranche structure is this: losses from the pool hit the lowest tranche first. The bottom tranche absorbs losses until it is exhausted. Only then do losses reach the next tranche up. The senior tranche, the top layer, only suffers losses if the entire pool experiences catastrophic defaults. This logic allowed rating agencies to rate the senior tranche AAA even when the underlying bonds feeding the CDO were rated BBB or lower. The mathematics of the structure appeared to create safety from risk, provided one assumption held. That assumption was that the underlying assets would not all fail simultaneously.
The mathematical models used by the rating agencies to rate CDO tranches assumed that mortgage defaults were largely independent events. If a borrower in Ohio defaulted, it said nothing about whether a borrower in Florida would default. This assumption had been approximately true for the previous 50 years of the U.S. housing market, because housing downturns had always been regional, not national. The assumption was catastrophically wrong for the following reason. The loans inside these CDOs were not diverse. They were all subprime loans issued under the same lowered standards to the same category of borrower in the same rapidly inflating market. When the market turned, they would all fail for the same reason at the same time. The diversification that justified AAA ratings did not exist. The rating agencies' models did not measure it. Some people inside the agencies knew this. This email was written by a Moody's analyst in June 2006. It is document 38 in the Financial Crisis Inquiry Commission's public exhibit record. The analyst states explicitly that the rating models being used had never been tested in a down market of the current magnitude. He is describing, in plain language, the limits of the models producing the AAA ratings that the entire system depended on. This email existed inside Moody's in June 2006. The ratings continued. The securities continued to sell. The machine continued to run. CDO issuance tripled between 2003 and 2005. It nearly doubled again by 2006, reaching $488 billion in a single year. The acceleration point is 2004. That is the year the machine reached self-sustaining velocity, where the volume of CDOs being issued was large enough to generate its own momentum, its own workforce, its own political protection, and its own consensus that everything was functioning normally. $488 billion in CDOs issued in 2006 alone. Most of it rated AAA. Most of it backed ultimately by subprime mortgages issued to borrowers who could not afford them. The second instrument is the synthetic CDO. It requires a precise definition because its implications are not intuitive. A regular CDO contains actual mortgages. The money flowing through it represents real loan payments from real borrowers. If you total all the CDOs in existence, their value is bounded by the underlying mortgage market. A synthetic CDO contains no mortgages. It contains credit default swaps, which are instruments that pay out when an underlying security fails. A synthetic CDO is, in structural terms, a bet on whether a set of mortgage securities will perform or fail. The critical implication: you can create an unlimited number of synthetic CDOs referencing the same underlying mortgage pool. There is no natural limit to the total exposure the system can accumulate against a fixed set of actual mortgages. This is why, when the mortgages failed, the losses were many multiples of the actual mortgage market. AIG, American International Group, was one of the largest insurance companies in the world. It had a financial products division that wrote credit default swaps, essentially insurance contracts on mortgage securities. If the securities failed, AIG would pay the holder. By 2007, AIG's financial products division had written $440 billion in credit default swap exposure against mortgage securities. $440 billion against almost no capital reserve.
AIG was not required to hold capital against these positions because credit default swaps were classified as derivatives, not insurance, and therefore not subject to insurance capital requirements. This was legal. This was disclosed in their annual filings. This was the position AIG held when the mortgage market turned.
This is the complete chain. A subprime borrower takes a mortgage they cannot sustainably afford. That mortgage is packaged into a mortgage-backed security, obscuring its quality. The riskiest tranches of that security are fed into a CDO and re-rated AAA. A synthetic CDO is created, referencing the same pool, multiplying exposure without adding a single additional mortgage. AIG writes insurance against the synthetic CDO, with no capital backing the position. One borrower defaulting produces losses that travel through 5 layers of amplification before they reach the institutions and investors who are holding the final instruments. This is the machine. It was not hidden. It was described in prospectuses, disclosed in filings, discussed at industry conferences. The information was available. The incentive to stop was not. By 2006, structured finance, the ratings applied to CDOs and mortgage-backed securities, represented 44% of Moody's total revenue. That is $881 million from a single business line in a single year. This does not prove corruption. It proves dependency. When nearly half your revenue comes from one category of client, the structural pressure to maintain that relationship is not something that requires a conspiracy. It is something that operates automatically through ordinary institutional behavior. The ratings agencies were financially dependent on the machine they were certifying as safe. This email was written by a Standard & Poor's analyst in April 2006. It is FCIC Exhibit 41, Public Record. The phrase "house of cards" appears in an internal email describing the market this analyst was rating. The writer expresses the hope that they will be wealthy and retired before it collapses. The analyst understood what the structure was. The ratings continued. The machine continued. 2 years later, the house of cards faltered. Most of the analysts were not yet retired. Robert Shiller, the Yale economist who would later win the Nobel Prize, published the second edition of Irrational Exuberance in 2005. It contained this chart. It showed that U.S. housing prices, adjusted for inflation, had deviated further from their historical trend line than at any point in modern American history. Shiller was not alone in identifying this. The deviation was visible in public data available to anyone who looked. The machine was inflating the asset whose performance the machine depended on. Housing prices had to keep rising for the mortgage payments feeding the securities to keep performing. When prices stopped rising, the entire structure lost its foundational assumption. Prices peaked in July 2006 and began falling. By 2006, $1.3 trillion in subprime mortgages were outstanding in the United States. In 1993, the figure was $190 billion, 7 times growth in 13 years. These were loans made to borrowers with impaired credit histories, frequently at teaser rates that would reset to significantly higher payments after 2 or 3 years. The borrowers could afford the teaser rate. The model assumed they would refinance before the reset, which required housing prices to keep rising. By 2006, prices had stopped rising. The resets were approaching. The borrowers could not refinance into falling value homes. The defaults were beginning. The regulatory environment that allowed the machine to operate was not an accident of omission. It was the result of specific legislative and regulatory decisions made between 1999 and 2004. The repeal of Glass-Steagall in 1999 allowed commercial banks to operate as investment banks. The SEC's 2004 exemption allowed large broker-dealers to increase leverage far beyond previous limits. The Office of the Comptroller of the Currency preempted state predatory lending laws in 2004, removing the last state-level check on subprime loan terms. The Commodity Futures Modernization Act of 2000 explicitly prohibited federal oversight of credit default swaps. Each of these decisions was advocated for by the financial industry. Each was made by elected and appointed officials. Each is documented. The machine was complete by 2006. Its components were in place, its volume was at maximum, and its foundational assumption that housing prices would continue rising had just been invalidated. Section 3 is what happened next. The trigger was not a surprise event. It was the arrival of an outcome that was mathematically embedded in the structure from the beginning. When housing prices stopped rising, subprime borrowers could not refinance. When they could not refinance, their teaser rates reset. When the rates reset, they defaulted. The machine had no mechanism for this outcome, because the machine had been designed assuming this outcome would not occur. This chart shows the relationship between housing prices and subprime default rates from 2004 to 2008. The relationship is precise. Housing prices peaked in the third quarter of 2006. Subprime defaults began rising in the fourth quarter of 2006, 1 quarter later. The 1-quarter lag is exactly the time required for a borrower to miss a first payment after a rate reset. It is not coincidence. It is mechanism. By the fourth quarter of 2007, 20% of all subprime mortgages in the United States were delinquent or in foreclosure. The securities built on those mortgages were losing value. The CDOs built on those securities were losing value. But the market had not yet understood the scale of the problem. On June 22, 2007, Bear Stearns sent a letter to investors in its high-grade structured credit strategies fund. The letter stated that investors were not anticipated to suffer any loss of principal. On July 17, 2007, 25 days later, Bear Stearns disclosed that one fund had lost 91% of its value. The other fund had lost essentially everything. The question of what Bear Stearns knew between June 22 and July 17 is documented in the FCIC report and the subsequent criminal investigation. What is certain is that the June 22 letter was the first public signal to the market that the pricing of structured credit instruments had been fictional. The period between February and October 2007 is the public emergence of the crisis. Each event on this timeline represents a point where the system's actual condition became visible, not to insiders, but to the market. The critical date is August 9, 2007. BNP Paribas, one of the largest banks in Europe, suspended 3 of its investment funds because it stated that it could no longer value the U.S. mortgage securities inside them. This was not a liquidity problem. BNP Paribas had money. It could not determine what its assets were worth. That is a valuation problem, which is a different and more serious condition. When you cannot value your assets, you cannot assess your solvency. When you cannot assess your solvency, you cannot assess anyone else's either. Interbank lending, the overnight loans that banks make each other constantly to manage daily cash flow, began freezing on August 9, 2007. The LIBOR-OIS spread is a technical measure, but its meaning is simple. It measures the difference between what banks charge each other for short-term loans and what they could earn risk-free from the central bank. When the spread is low, banks trust each other. When it rises, they don't. From January to July 2007, the spread was near zero. On August 9th, it spiked to 95 basis points in a single session. Banks had stopped trusting each other's balance sheets overnight. Literally overnight. That spike is the financial system's vital sign going abnormal. It did not return to normal. It spiked again to 364 basis points in September 2008. That second spike is the system going critical. This distinction is the most important concept in understanding why the policy response failed to prevent the September 2008 events. A liquidity crisis occurs when an institution has good assets but temporarily cannot raise cash.
The solution is a central bank loan against those assets. The institution is solvent, it just needs time. A solvency crisis occurs when an institution's assets are worth less than its liabilities. No central bank loan fixes this. You cannot lend your way out of a hole in the balance sheet. The only solutions are recapitalization, injecting new equity, or failure. Between August 2007 and September 2008, the Federal Reserve and the Treasury treated what was, in significant part, a solvency crisis as a liquidity crisis. They injected short-term cash into a system with long-term holes in its balance sheets. This is documented in the Fed's own transcripts from the period. Between July 2007 and June 2008, the major global banks disclosed $232 billion in write-downs on mortgage-related assets. This is what they disclosed. Write-downs represent assets whose market value has fallen below their book value, the value at which they were carried on the balance sheet. $232 billion in 9 months means the assets inside these banks were worth significantly less than the banks had been reporting. The question that the interbank market was asking, and could not answer, was whether the disclosed write-downs were the total problem or the beginning of it. They were the beginning. This statement was made inside a Federal Open Market Committee meeting on October 30, 2007, 11 months before Lehman Brothers filed for bankruptcy. A Federal Reserve governor described the losses as permanent, not temporary, not a correction, permanent structural losses that would not be recovered when conditions improved. The transcript was classified at the time and released publicly in 2013. It is now part of the Federal Reserve's public archive. The Fed's public statements in October 2007 described the situation as serious but manageable. The internal transcripts describe something different. That gap is documented. Between the BNP Paribas suspension on August 9, 2007, and the bankruptcy of Lehman Brothers on September 15, 2008, 13 months elapsed. Those 13 months are the period during which the collapse was not yet inevitable, when different decisions by policymakers, different disclosures by institutions, or different regulatory responses might have altered the outcome. The FCIC report examines each of those 13 months in detail. Its conclusion is that the crisis was not inevitable in the sense of being impossible to prevent, but that preventing it would have required acknowledging publicly what was known privately, which no institution involved was prepared to do. The mortgage market is in distress. The securities built on mortgages are losing value. The banks holding them are writing down losses. The interbank market has frozen. None of this has yet affected an ordinary person who does not work in finance and does not own mortgage securities. Section 4 is how it got to them. Transmission is the process by which a financial system problem becomes an economic problem. It is the mechanism by which losses inside banks become unemployment, business failure, and household financial destruction outside them. Understanding the transmission in 2008 means understanding 3 specific channels: the funding market, the money market, and the credit market. Banks do not fund themselves from deposits alone. Large financial institutions borrow enormous amounts of money overnight, every night, to fund their daily operations and maintain their balance sheet positions. The primary mechanism is the repo market, repurchase agreements. A bank posts securities as collateral and receives cash overnight. The next morning, it repays the cash and retrieves the collateral. By 2007, $3 to $5 trillion moved through the repo market daily in the United States alone. When the value of the collateral becomes uncertain, when the securities being posted are mortgage-backed instruments of unknown value, the lenders in the repo market either demand more collateral for the same loan or stop lending entirely. This is what began happening in August 2007. The funding infrastructure of the global banking system started restricting. Not failing completely, restricting. Banks that had depended on overnight funding for years found themselves paying more for it, receiving less of it, or being asked to provide different collateral than they held. Bear Stearns is the first institution to complete the transmission from distress to failure.
The sequence takes 11 weeks in early 2008 and shows exactly how a funding run operates at the institutional level. On March 10, 2008, Bear Stearns' CEO publicly stated there was no liquidity crisis at Bear. This statement was made to stabilize market confidence. 3 days later, Bear's overnight funding had collapsed. Its $18 billion cash reserve was exhausted in 24 hours as counterparties refused to roll over overnight loans. On March 16th, JP Morgan acquired Bear Stearns for $2 per share. The previous year, Bear had traded at $170 per share. The Federal Reserve guaranteed $29 billion of Bear's toxic assets to make the acquisition possible. This was a decision to prevent Bear's failure from triggering immediate systemic collapse. It succeeded. For 6 months. Fannie Mae and Freddie Mac were government-sponsored enterprises, private companies with an implicit government guarantee. Together, they owned or guaranteed $5.4 trillion in mortgages, approximately half of all mortgages outstanding in the United States. They held $223 billion in capital against that exposure, a ratio of $24 in obligations per $1 in capital. As housing prices fell and mortgage defaults rose, their capital eroded. By summer 2008, both institutions were effectively insolvent. They could not be allowed to fail. A failure would have immediately impaired half of the U.S. mortgage market and the global investors holding their guaranteed securities. On September 7, 2008, the U.S. government placed both institutions into conservatorship. This was a nationalization in every functional sense. The total cost to taxpayers reached $187 billion. $187 billion. The cost of the Fannie and Freddie conservatorship to U.S. taxpayers by 2012. This is distinct from and prior to the TARP program. It is not included in most summaries of the total bailout cost. The Fannie and Freddie rescue alone exceeded the initial requested size of the entire TARP program. Both institutions had operated for decades under the assumption that their implicit government guarantee made them safe to lend to at lower rates than purely private competitors. That guarantee was, in September 2008, made explicit at a cost of $187 billion. The transmission from the financial system to the real economy operated through 3 channels simultaneously. Credit contraction. Banks with impaired balance sheets stopped lending to businesses and households. Loans that would previously have been approved were declined. Credit lines were reduced. Businesses that had operated on revolving credit found it reduced or withdrawn. Commercial paper freeze. Large corporations routinely fund short-term operations by issuing commercial paper, short-term debt bought by money market funds. When money market funds faced their own crisis in September 2008, the commercial paper market froze. Companies that had nothing to do with mortgages suddenly could not fund their daily operations. Confidence collapse. Households and businesses that observed the system in visible distress reduced spending and investment preemptively, regardless of their own financial position. Precautionary behavior at scale produced the same economic outcome as an actual shortage of credit. All 3 channels operated simultaneously beginning in September 2008. The relationship between credit tightening and unemployment is direct and measurable. As banks restricted lending, visible in the Federal Reserve's quarterly Senior Loan Officer Survey, unemployment rose in sequence. By the third quarter of 2008, 85% of surveyed banks were tightening lending standards. This is an extraordinary figure. It means the vast majority of the banking system simultaneously withdrew from normal lending activity. By the second quarter of 2009, U.S. unemployment had reached 9.5%, a figure that does not include discouraged workers who stopped searching or part-time workers seeking full-time employment. The broader U6 measure peaked at 17.2% in 2010. These are the people at the end of the transmission chain. They did not hold mortgage securities. They did not work in finance. They were the terminal point of a mechanism that began with an incentive structure built 15 years earlier. $11 trillion in U.S. household wealth was destroyed between 2007 and 2009. $9 trillion in housing value, $2 trillion in retirement savings. This figure represents the aggregate destruction of wealth accumulated over decades by households that had no direct exposure to the financial instruments that caused the crisis. Their homes lost value because the securitization machine had inflated prices beyond fundamental value. Their retirement accounts lost value because the pension funds and mutual funds holding their savings were invested in securities that the rating agencies had certified as safe. $11 trillion. The cost was not borne by the institutions that built the machine.
The Financial Crisis Inquiry Commission's central conclusion, stated on page 17 of the final report: human action and inaction, not market forces operating beyond human control, not unpredictable events. Decisions made by identifiable people at identifiable institutions, and decisions not made when they could have been. 4 of the 10 commissioners filed minority dissents, disagreeing with specific findings or emphasis. None disputed the core conclusion that the crisis was preventable. The transmission is complete. The financial system crisis has entered the real economy. Unemployment is rising. Credit is contracting. Household wealth is falling. The most acute phase of the crisis, the 7 days in September 2008 that brought the system closest to complete failure, is Section 5. 7 days, September 7th to September 15th, 2008. In 7 days, the 2 largest mortgage institutions in the U.S. were nationalized. The 4th largest investment bank in the world filed for bankruptcy. The largest insurance company in the world required an emergency government loan to survive, and the commercial paper market that funds American corporate payroll froze. This section reconstructs those 7 days in sequence. The sequence is precise, and the interactions between events matter. September 7th. Fannie and Freddie are placed into conservatorship. This removes one form of systemic uncertainty, their fate, but simultaneously signals that no institution is too large to require government intervention. September 9th through 14th. Lehman Brothers funding is collapsing in the same pattern that destroyed Bear Stearns 6 months earlier. Over the weekend of September 12th to 14th, Treasury Secretary Paulson and Federal Reserve President Geithner convened the CEOs of the major Wall Street banks at the New York Fed, attempting to organize a private sector rescue of Lehman. No rescue materializes. September 14th. Merrill Lynch, recognizing that it will face the same funding crisis as Lehman within days, negotiates an emergency acquisition by Bank of America in 48 hours. September 15th. Lehman files for bankruptcy. $639 billion in assets at the time of filing. The previous largest bankruptcy in U.S. history was WorldCom in 2002 at $103 billion. Lehman exceeded that by more than 6 times in a single filing. The immediate consequence of the filing was not primarily the direct losses it crystallized, though those were enormous. The immediate consequence was what it signaled about the viability of every other institution holding similar assets. If Lehman's balance sheet was not what its filings suggested, what did that mean for the balance sheets of Goldman, Morgan Stanley, Citigroup, Bank of America, all of which held similar instruments valued by similar methods? The answer to that question was not knowable with certainty. That uncertainty was the weapon. September 16th, 2008, 1 day after Lehman's bankruptcy. The Reserve Primary Fund, one of the oldest money market funds in the United States, announced that its net asset value had fallen below $1 per share. It had broken the buck. This phrase had occurred once before in the history of money market funds, in 1994, in a fund so small it had minimal systemic impact. The Reserve Primary Fund held $785 million in Lehman commercial paper, now worth 0.
Its share price fell to 97 cents. Money market funds were where corporations kept their operating cash, where hospitals kept payroll funds, where municipalities kept short-term reserves. They were considered equivalent to cash, a fixed dollar in, a fixed dollar out. When one broke, every institution holding money market fund shares questioned whether theirs would break next. $300 billion was withdrawn in the following 48 hours. The money market run produced an immediate consequence that had nothing to do with mortgages or investment banks. Money market funds were the primary buyers of commercial paper, short-term corporate debt used to fund day-to-day operations. General Electric issued commercial paper. Hospital systems issued commercial paper. Major retailers issued commercial paper. It was the standard mechanism by which large organizations managed the gap between when they paid expenses and when they received revenue. When money market funds began receiving $300 billion in redemption requests, they stopped buying commercial paper. The commercial paper market froze on September 17, 2008. Companies that had issued commercial paper on Monday could not roll it over, issue new paper to replace maturing paper on Thursday. Their Friday payroll was at risk. Not because they were insolvent, because the short-term funding market that every large American corporation used as standard infrastructure had stopped functioning. AIG's failure would have been categorically different from Lehman's failure. Here is why. When Lehman filed for bankruptcy, its credit rating was immediately downgraded. AIG's rating was simultaneously downgraded because AIG held Lehman exposure. The downgrade triggered contractual clauses in AIG's credit default swap agreements, requiring AIG to post additional collateral immediately. AIG owed $14.5 billion in collateral calls on the afternoon of September 15th. It did not have $14.5 billion in available liquid assets. If AIG defaulted on those collateral calls, $440 billion in credit default swap obligations would have been triggered simultaneously at counterparties including Goldman Sachs, Deutsche Bank, Société Générale, and Barclays. All of them would have faced immediate solvency questions. The Federal Reserve concluded that allowing AIG to fail would cause a collapse larger than the system could absorb. On September 16th, it extended an $85 billion emergency credit facility. The government took 79.9% of AIG's equity in exchange. 8 days after Lehman's bankruptcy, Treasury Secretary Paulson testified before Congress, requesting $700 billion in emergency authority to purchase toxic assets from failing banks. His testimony described a potential major collapse of the financial system. His internal communications, released later under the Freedom of Information Act, and his subsequent memoir describe the situation in more specific terms, that without immediate intervention, the payment system, the infrastructure through which all electronic transactions occur, was at risk of functional failure. Paulson reportedly told congressional leaders in a private briefing that without immediate action, the United States risked the kind of financial collapse that stops ATMs from dispensing cash. This was not hyperbole. It was the Federal Reserve's and Treasury's own assessment of where the system was on September 18, 2008. The stock market's response to the September events is visible in this chart. The S&P 500 fell 29.3% between September 15th and October 10th, 25 trading days. The single largest single-day point drop in Dow Jones history occurred on September 29th, when the House of Representatives voted down the initial TARP proposal. 777 points in one session, $1.2 trillion in market capitalization erased in 6.5 hours. These figures represent retirement accounts, pension funds, and endowments, the accumulated savings of institutions and individuals who had no direct exposure to the instruments that caused the crisis. Troubled Asset Relief Program, TARP, was authorized by Congress on October 3, 2008, for up to $700 billion. Its stated purpose was to purchase toxic mortgage assets from banks, removing the uncertainty from bank balance sheets by taking the problem assets into government ownership. This is not what happened.
Within 2 weeks of the TARP authorization, Treasury Secretary Paulson announced that the primary use of TARP funds would be direct equity injection into banks, the government purchasing preferred shares in the largest financial institutions. This made the government a shareholder in Goldman Sachs, Morgan Stanley, Citigroup, Bank of America, JP Morgan, and others. The toxic assets remained on the balance sheets. They were not purchased. The equity injection restored capital ratios and stabilized the institutions, but the underlying problem assets were not removed.
This strategic shift without an additional congressional vote. The TARP legislation gave Treasury broad authority, and Treasury used it. $426 billion was dispersed through TARP to financial institutions. The 10 largest recipients are shown here. The outcome that is rarely discussed. By 2014, the Treasury had recovered $441 billion from TARP investments, a net profit of $15 billion to U.S. taxpayers on the direct financial investment. This figure is accurate, and it is also incomplete. It measures only the direct return on TARP capital. It does not measure the $11 trillion in household wealth destroyed in 2008 and 2009. It does not measure the 8 million jobs lost. It does not measure the Federal Reserve's separate programs, which extended trillions in emergency lending at below-market rates, which represented a subsidy to the banking system that is not included in TARP's profit calculation. The TARP profit is a real number. It is not the whole picture. If we don't do this, we may not have an economy on Monday. Attributed to Federal Reserve Chairman Ben Bernanke in a private briefing to congressional leaders on September 23, 2008. The statement appears in multiple memoirs and has been confirmed by multiple participants. The man responsible for the stability of the U.S. monetary system told elected officials that without immediate congressional action, the economy might not be functional by the following week. This is the closest the system came to complete failure. This is the moment that justifies the word collapse rather than crisis. The system held. The TARP legislation passed on its second congressional vote on October 3, 2008. The equity injections stabilized the largest institutions. The commercial paper market was backstopped by the Federal Reserve's commercial paper funding facility. The acute phase of the collapse ended by November 2008. Section 6 is what happened after. The aftermath of a financial crisis has two components. The first is accountability. Who was held responsible for the decisions that caused it? The second is reform. What structural changes were made to prevent recurrence? Both components of the 2008 aftermath are documented. Both are contested. Both are measurable against the evidence available. One senior banker was prosecuted and jailed for conduct related to the 2008 financial crisis. Kareem Sarageldin, a Credit Suisse executive, was sentenced to 30 months in prison in 2013 for mismarking the value of bonds in his trading book in 2007, inflating their value to conceal losses and protect his bonus. His conduct caused losses of approximately $235 million. The financial crisis, by the Federal Reserve's own estimate, destroyed $11 trillion in household wealth and 8 million jobs. One person went to prison. The Department of Justice's position was that it could not prove criminal intent beyond reasonable doubt in most instances, that the decisions made were bad decisions, negligent decisions, and decisions driven by perverse incentives, but not provably criminal ones under existing law. That position is legally coherent. It is also a statement about what the law covered and what it did not. Iceland experienced a proportionally larger banking collapse than the United States in 2008. Its three major banks had accumulated assets equal to 10 times Iceland's GDP. When they failed completely. Iceland made different choices. It allowed its banks to fail rather than recapitalizing them with public funds. It protected domestic depositors but imposed losses on foreign creditors. Its Special Investigation Commission produced a 9-volume report identifying specific individuals responsible for the collapse. 26 bankers were prosecuted and jailed. Iceland's GDP returned to its pre-crisis level in the first quarter of 2011, slightly ahead of the United States, which reached that milestone in the third quarter of 2011. The comparison does not prove that Iceland's approach was universally superior. Iceland's economy is small, its banking system was structurally different, and the IMF's involvement in Iceland's recovery was substantial. What the comparison proves is that the outcomes chosen in the United States were choices, not inevitabilities. The Dodd-Frank Wall Street Reform and Consumer Protection Act was signed into law in July 2010. It is the most significant financial regulatory legislation since the reforms of the 1930s. Its meaningful accomplishments are documented. The Consumer Financial Protection Bureau has returned $17 billion to consumers since its founding. The Volcker Rule limits the ability of deposit-taking banks to make proprietary bets with insured funds. Stress tests have increased capital buffers at the largest institutions measurably. Derivatives clearing has reduced bilateral counterparty exposure. What Dodd-Frank did not address is equally documented. The credit rating agency business model, payment by the rated entity, was not restructured. The originate-to-distribute mortgage model was not prohibited, only modified at the margins. Synthetic CDOs remain legal instruments. The implicit government guarantee for systemically important institutions, the expectation that they will be rescued in a crisis, was not resolved. The causes of the 2008 crisis were partially addressed. The question of whether they were sufficiently addressed is not settled. The 5 largest U.S. banks held 28% of total U.S. banking assets in 2000. In 2023, they hold 54%. The institutions that were considered too large to allow failure in 2008 are, by the measure of asset concentration, substantially larger today than they were then. J.P. Morgan Chase, which acquired Bear Stearns and Washington Mutual during the crisis with government assistance, is currently the largest bank in American history by assets. Bank of America, which acquired Merrill Lynch during the crisis, is the second largest. The consolidation that occurred during the crisis response created the institutions that currently dominate the U.S. banking system. On March 10, 2023, Silicon Valley Bank failed. It held $209 billion in assets, making it the largest U.S. bank failure since 2008. The mechanism was different from 2008. SVB's problem was a mismatch between long-duration bonds on its asset side and short-term deposits on its liability side, a classic banking risk that interest rate increases made acute. What was not different, the speed of the run, enabled by digital banking that allowed billions in withdrawals in hours rather than days. The regulator's decision to guarantee deposits above the insured limit, a decision made within 48 hours, to prevent contagion. The subsequent debate about whether that guarantee extended the too-big-to-fail protection to institutions below the systemically important threshold. The questions raised in 2008 were not answered by 2023. U.S. household debt as a percentage of GDP peaked at 99% in 2007, the product of the mortgage expansion this video has documented. It has not returned to that level. The deleveraging that occurred between 2009 and 2013, the process by which households paid down debt rather than taking on new debt, is a primary reason the recovery from 2008 was slower than recoveries from previous recessions. Deleveraging and growth are largely incompatible in the short term. The current level of 73% is lower than the 2007 peak, but significantly higher than the norms of the period before securitization expanded dramatically. Whether that level is sustainable depends on income growth, interest rates, and asset prices, the same 3 variables that determined the outcome in 2008. The first sentence of the Financial Crisis Inquiry Commission's conclusions chapter. Not partially avoidable, not difficult to prevent, avoidable. The commission spent 18 months examining the crisis. It interviewed 700 witnesses, It reviewed millions of pages of documents. It produced 662 pages of findings. The first sentence of its conclusions is, "We conclude this financial crisis was avoidable." That sentence carries the weight of everything in this video.